Isn't it fascinating when you really get down to the nitty gritty and you want to get really detailed and you put away this notion of it's complication. No, it's a deep study of something that if it's really rigged, if it's really controlled, you would see evidences that when you place price under strict scrutiny, critical theory and analysis, what is happening at this given time? What's happening at that given candlestick? If there's a wick, why is that wick doing that? Why is that wick only moving this far below its open, or this far below its close, or above its close, or above its open, in deference to a premium wick or a difference of the discount wick? What makes the wick that length? Why is it doing it? It's not random. It's not random at all. And if it's going to present that wick, and if it is controlled, if there is an algorithm, if it's 100% scripted, that wick is going to be implementing something in the future because everything has its place. Everything has its place. So when we see a wick, if there's a candlestick there, ignore it, go to the wick. The wick takes precedence because it's going to be the greater gap. Because what is the wick doing? It's proving a rejection at an interval in time, whatever time frame you're looking at, and when it forms. That wick is showing you that it's traversed down when it's a discount wick. It trades down to its lowest form, makes the low of the candle, and then goes back up and closes. So now you have a wick below the body of the candle. That range is not random. It's never random. It's always going to be implemented in the future. But if it's an extended, long, lengthy candlestick and it's sharing the same range with the newest candle to the right of it, ignore that candle to the right. Treat that wick as if it is a real fair value gap. And if it's doing that wick at a low that forms just a little bit lower than that, in other words, it creates a pivot and starts to rotate higher, swing low, that wick will act as an inversion fair value gap. And out of one of my students asking about whether or not I would use a mitigation block, going into what he was asking or what you were prompting me to look at, my eye went right to that wick because that's the hierarchy of it. The wick is going to take precedence over every other PD array because it's manipulation of a range that is not artificial. It's designed to be there. It's put there. So when we see these wicks that form around news, that's not entirely random because they're just trying to get overzealous about it. Because why is it that you can go back and look at PPI numbers and CPI numbers, and it'll go right to a volume imbalance and stop? It'll go right to consequent encroachment of an opening range gap. It'll go right to the lower quarter quadrant of a new day opening gap or a new week opening gap. It's not going random places. It's going to a very specific price point. So when we look at wicks, wherever there are wicks inside of consolidations are gold mines. They're absolutely gold mines because as long as you know where you're likely to be going to, directional wise, that wick will tell you if it's bullish, it's going to support price in the upper half of that wick. If it can't even touch the upper half, or consequent encroachment rather, if it can't even touch that and starts to rally, what is that indicating? Strength. So is it going to run for a premium inefficiency above market price, or it's going to run for a short-term high for liquidity? If there is neither, it will run up, create a short-term high, sell off, and then go back for it, and there's the liquidity engineered. And look at your ES chart, and you'll see that very thing happening here.